Priya Misra. She represents TD Securities. Priya, fantastic to have you back on. Thank you for joining us. Priya, where do we go from here? Clearly, the heart of the problem is this tug of war between bonds and stocks.
Right. Thanks for having me on. I agree, and I think it's the correlation between the two that, I think what QE did, starting 2009, since we had the Fed QE followed up ECB, was, it effectively crushed volatility and it brought risk premiums much lower. And I think much of this repricing is essentially this end of global QE. Because even though the Fed started tapering, almost 6 months ago, now the thought is that the ECB is about to start tapering. The BOJ might be tapering as well. So this, at the end of QE, will, I think, increase volatility as we've already seen. I think this is just it's moving to, it's transitioning to, I guess, a new normal now. And you can have a situation where all asset classes can underperform. So we've seen a breakdown of the normal correlation, but I'm not sure we should be back to that correlation where interest rates are low, equities are high. You can potentially have what we're seeing now, higher interest rates, lower equities, until we reach a level where, you're repriced or taken out that QE expectations. I think much of this is just that QE expectations being taken out of sort of every market out there.
Given the way how the dollar index has moved, do you think this so-called cozy trade of short dollar, long commodities, long emerging market equities, that also could change and that could lead to further disruption?
Yeah, I think again the dollar weakness was a QE trade to some extent, and we started to see outperformance from the rest of the world relative to the US. So that's why the dollar has been weakening. I think what we've seen now is more knee-jerk just flight to quality into the dollar. But if indeed the rest of the world, and this is where, I'm not as convinced that Europe is entirely out of the woods. I know, the thought is that the ECB will be able to end QE. I think at some point possible that we are a little overdone in our optimism. But, that's a few months out. I think I'm not sure it pushes back just yet, which is why I would say that the dollar can continue to strengthen as we are pricing in sort of, more flight to quality, and, that ultimately does hurting commodities and the dollar and EM. I think the interesting thought is, there's a lot of views that this is all driven by a reflation trade. But really, if reflation was driving the entire price action the last couple of weeks, then why are equities off? Because actually, reflation should be good for equity. Why are commodities off? So I think, inflation or reflation is an easy explanation, but it's not consistent with all the action. So I think, the dollar can continue to strengthen. If actually this is about taking out global QE, then the dollar can strengthen to the point where it starts putting enough downward pressure on inflation in the US that then it actually slows the Fed down. So there'll be some breaking point, but I'm not sure we're there yet. We've just started the higher in the dollar in our view.
Priya, so what is it that we're staring at? Because, Bridgewater Associates' Bob Prince believes that the world markets were getting extremely complacent and there's a bigger shakeout coming. He says that in what we've seen in the last fortnight, this is not it. Brace yourselves. There's going to be further weakness in the market. Would you say that what we saw in the last fortnight was just a flavor of what's coming and just maybe world markets would once again realign to the new norm with the way the dollar as well as the index has been panning out and what's happening in commodity markets separately?
Right. I'm somewhat sympathetic to the Bridgewater view because we are seeing global central banks starting to normalize, but actually long-term economic growth fundamentals, we're not sure that that is much higher. So if you look at the U.S., demographics or productivity haven't particularly picked up. So the question always was, how much can the Fed hike or, how much can they let the portfolio run off before too much? And we're sort of figuring what that level is. It's clearly not here. So I think interest rates can rise. There's no sign so far that this rate rise is having any effect on the economy. In fact, we heard from New York Fed President Dudley, who called it small potatoes. which tells me that the Fed's threshold, and I would say global central bank threshold, the act is much higher than where we are, or much lower, in the sense that they're not panicking just yet. So I do worry that if interest rates continue to rise as we are pricing out accommodation from global central banks, I think all other asset classes have to react. So higher vol, lower equities, stronger dollar, I guess weaker EM. And then at some point, it'll have to align itself to fundamentals when we realize that high interest rates began to hurt the U.S. housing market, for example. But that's a ways off from here. So I think you're in a period of turbulence until we can sort of go back to fundamentals and say, look, interest rates should not be higher than a certain level. So we're thinking.
Priya, really running out of time. Priya, thanks so much for taking the time out and speaking with us today.